Hey Tribe, Sean here. In this video, I'll be sharing with you a particular secret formula that help investors, traders, and even gamblers beat the casino, the stock market, making millions and even billions of dollars. Yes, you heard me right. This formula is known as the Fortune's formula. It is a formula that makes millions. I want to start by asking you a question. Can we beat the casino? Typically, the answer is no. And the reason why I ask this is because it will relate back to how we trade or invest in the stock market. If you think you cannot beat the casino, you may be wrong. Typically, most people will not beat the casino because the odds are against us. So example, when we play blackjack, our odds of winning goes as high as 42.22%, but it will never win the probability of the house winning, which is about 49%. And if you go into the game of roulette, the best bet that allows you the highest probability of winning is you bet on black or red, which gives you a winning chance of not 50%, unlike what a lot of people are thinking. Is because on the roulette wheel, there is a particular green slot which tilts the advantage towards the house, making our probability of winning only 48.6%. So while the odds are against us, there's this one gentleman known as Edward Top. He took on the casino and won consistently. In fact, he won so much, he got banned in the casino and he was never to set foot in any casino in the world again. How did he win? He used this particular formula known as the Fortune's formula. And in this video, you'll be learning exactly how it works and how you can use it for stocks and options investing. And it is relevant because after he was banned from the casino, he went into what he thought was the most legalized and biggest casino in the world, the options market. And he made $800 million. Edward Top was a lecturer in MIT and he's a teacher by heart, so he published his whole entire secret formula in his new book called A Man for All Markets. And if you want a more in-depth version, it is in this particular book by Edward Top, and it's the Kelly Capital Growth Investment Criterion. And in this video, I'll simplify it for you instead of you having to read 845 pages. Edward Top and many of the top investors use this formula called the Kelly Criterion formula. And this formula helps us to calculate the optimized amount of betting size we should use to go into each trade. And this is what the formula looks like. The K percentage is the percentage of the portfolio we should put inside a particular trade to risk it. And this is determined by the winning probability minus the losing probability divided by the win-loss ratio. Let me give you a practical example of what this looks like, and you will witness for yourself why this formula is able to make us millions or even billions of dollars when we apply it consistently. In order to use this secret formula effectively, we need to have 4 numbers. Number 1, the winning probability. And we can get this probability by doing multiple trades, and we check back on how many percentage of the trades are winning trades. Number 2, we need to know the losing probability. Now this is simple. We just need to take 100% minus off the winning probability. For example, if we win 60% of the time, the losing probability will be 40%. Number 3, the average winning amount. This means each time we win, how much can we expect to win? And number 4, the average losing amount. Each time we lose, how much can we expect to lose? With these 4 numbers, we can easily determine what should be our optimized bet size in order for us to grow a capital of $1,000 to potentially even millions of dollars. As an investor and trader myself, I do multiple backtesting and also journaling of my trades so that I can know all this probability and my win-lose amount. So let me give you some practical examples and we can use the calculator to see what is the optimized bet size. So I've created a full Kelly Criterion calculator and simulation for you to use this calculator to calculate your optimized bet size and also look through your entire equity curve through the journey. If you want to get hold of this calculator, simply click on the link, input your email, and I'll email you this calculator. Now this calculator requires a few numbers to key in, and it is all highlighted mainly in yellow. So first of all, the capital. For this example, I'll use $1,000 as our initial capital. Number 2, our average profit, how much we'll make if we win. Number 3, probability of winning, and then you help me calculate the probability of losing just by using 1 minus away the percentage of winning, and the calculator will automatically calculate our optimized position. So using setup number 1, we have 863 trades, and out of there, 33% are winning trades and 66% are losing trades. So we got our first number. Let me just key this in. 33.02. And there we have our probability of losing, 66.98. Next, we need to find out each time we win, what is the average size. We can see from here, the average profit trade is $8.68. So let me key this in, $8.68. And the average losing trade is $4.37. Now, you can see right here, the calculator showed that our optimized position size is negative 0.7%. It means that we should not trade, or we should take an opposite direction of the trade. You can also see this number called the expected value. And it's also something that's negative. Expected value, if you look at the calculator, we take the winning probability multiply by the average profits. It means 33% of $8 minus away 66% of $4. This number is the expected amount that we will win each time we trade. And you can see the expected value is a negative $0.06. Means each time we trade, we can expect to lose money. So in this case, the Kelly Criterion shows us that we should not even take on this trade. Let's go to setup number 2. We can see that the winning percentage is still not very high, it's 32%. However, the profit is much higher and the losses is a little bit lesser. So let us input this into the calculator. 32.72%. Average profit, 9.29. And average losses, 3.54. Right now, we have a different picture. The expected value is 0.66. Because if you take 30% of $9, that's about $3. And if we take 60% of $3, that's about $2 plus. So if we take the probability of winning multiplied by the profit, this is our expected profit minus away expected loss, we still have a positive amount. Each time we trade, we still can make about 66 cents. So looking at the position we should take, it is about 7.08%. Now, using the Kelly Criterion sizing, 7.8% of $1,000 is $70.83. Meaning to say, this trade, the maximum I allow myself to enter and lose is $70.83. Taking $70.83, I will divide it by $3.54 because this is the average amount of losses. I can expect to lose this amount if this trade turns into a losing trade with a 67% chance of losing. So ultimately, I'm willing to take on 20 trades because if I lose 20 times $3.54, I will lose $70. So in the end, it will still only affect my whole entire capital by 7.08%. Simply put, when I go into this trade, maximum I'm willing to lose is 7% of my capital. If I do take on this trade, let's look at the simulation. So at the bottom, I have various simulation for a full Kelly Criterion, a half Kelly Criterion, a 1/3 and also a 1/4. What this means is, instead of 7%, I'm going to take only half of the position, 3.54%. And there's a 1/3 version and a 1/4 version. That's because the full Kelly Criterion will make you see a huge fluctuation in your equity that may not be something a lot of us may be able to handle. But let's take a look. So below here, I have a randomized calculation. Sometimes we'll win, sometimes we'll lose, and let's see what happens. So this Excel calculator, if you look at the formula, it's equals to random, meaning to say this number is entirely random. Each time we change a variable, a random number will appear. So let me just show you this. Instead of 3.54, let me change it to 3.5. Look at the number below. When I press enter, it becomes 0.77. So let me change it back. You can see the random number change again. This random number is totally decided by Excel, but each time, but based on my probability of win and lose, you can see if this number is below 0.32, I will consider it a win. If it's above 0.32, I will lose. And you can see based on the win-lose percentage, it will be around 30% of winning and 67% of losing. If I use the full Kelly Criterion, I'll be losing, winning 3 times, losing 2 times, winning 1 time, losing quite a number of times, a series of times. You will see my initial capital from $1,000 will become $900, 1,000, and it will go up to 2,000, 1,000. It will fluctuate. It will go down again on the 51 trade, okay, to $900. But eventually, when you do enough trades, based on the law of huge numbers, because the expected payout ratio it's positive, eventually our account will start to grow. But there will be times it goes as low as even $90 based on the law of huge numbers, our account will start to grow. But that's not before we hit certain series of huge losses, making our account grow from 1,000 all the way to even $200. But if we are persistent enough, it will eventually grow all the way back to our original amount and have a total profit of $170,000. This is after 1,000 trades. And based on our current setup, which is a high frequency trading, we can hit probably 1,000 trades in a couple of months. If you do a half Kelly Criterion, you will see less fluctuation, but of course, your eventual profit will also be lesser. Instead of 170,000, it will be 57,000. A 1/3 Kelly Criterion will be 20,000, and a quarter Kelly Criterion will be 11,000. So overall, you can see that this is a winning formula because the expected payout is positive. Based on Kelly Criterion, if you do the optimized sizing, you'll eventually win. Now, what if we don't do Kelly Criterion and like most newbies, we say, well, I'm going to put in half my position in. So I have this portion where you can see I'm going to put in 50%. And if I put in 50%, the amount that I invest will be vastly a lot more bigger. That is half my capital of $1,000. And remember, I have a 60% chance of losing. So if we use 50%, eventually I will be wiped out and I have no chance to recover. So that's why using the Kelly Criterion is a lot more scientifically proven. What if I put just, example, 40%? You can see that's also a chance for me to get wiped out as compared to Kelly Criterion making my whole entire capital profitable. Now let me show two other setups to explain a few variables. The third setup I have has a winning trade of 89%. However, do take note that the risk to reward ratio is extremely disadvantageous. Every time I win $3. Each time I lose $60. Even though I'm only losing 10% of the time, will this be a winning or losing trade? Let's use the calculator to find out. My winning percentage is 89.47%, and each time I win, it will be $3.49. Each time I lose, it will be a huge amount of $60.54. You can see immediately the expected value payout is negative 3.2. Each time I trade, I'm likely to lose $3.25. So my position is going to be minus 90%. We should not even enter this. Do take note that if the Kelly Criterion gives a very huge percentage due to very good probability of winning with good risk to reward ratio, I still suggest that we do not risk more than 20% of our capital each time. Now before I end, let me show you the latest setup that I have. So this setup is using gold for 15 minutes. We can see right here, the percentage of profit is 90%. So I'm going to key in right here, 90%. That's pretty good. My average profit is 3.51. My average loss is 8.72. 3.51, 8.72. We can see an expected value of 2.29, which is a very positive number. And you can see the full Kelly Criterion is suggesting that I take 65% of my capital to put into this particular setup. In my opinion, it is way too high. Even though the probability of winning is 90%, there may be a series of losers initially. Imagine if I lose the first trade, I will lose 65% of my capital. So let me give you an example right here. You can see I lose on my third trade and my $1,000 will drop to $500. If I have two back-to-back losing trades, that's where my entire capital may be wiped out and it's very hard to recover. So my suggestion is to not go more than 20%, even though the full Kelly Criterion calculator suggests that we go that high. So if you enjoyed this video and you want to learn more about investing wisely, backed by data and using proven formulas, do subscribe to our channel and leave a comment below to tell us what you want to learn next. I'll see you in the next video.